Hey everyone, welcome back to Corporate Decoder, the place where we break down the complex financial world and make it surprisingly entertaining. Let's just say Kroger has had a very interesting quarter for the books. You could say things got a little fermented. Alright folks, we are diving deep into Kroger's latest report, a quarterly update that has got a few surprises in store. Think of it as a financial checkup, and sometimes the doctor finds something unexpected. Kroger released its quarterly report for the period ending the 8th of November 2025, and we're going to peel back the layers and see what is really going on beneath the surface. And hey, if you appreciate getting the straight scoop on these corporate filings, make sure you are subscribed. We also have a Discord community linked in the description below where we talk about these filings and much more. Let's jump right into the numbers on the statement of operations. For the third quarter, Kroger reported sales of $33.8 billion. That sounds like a lot, and it is, but let's see how it stacks up. It is a slight increase of about 0.7% compared to the same time last year. Now, for the first 9 months of the year, sales hit $12.9 billion. Also, a very small change, but here is where things get a bit bumpy. While sales are relatively steady, take a look at the operating profit. For the third quarter, Kroger reported an operating loss of $1.5 billion. Yes, you heard that right, a loss. This is a massive drop from the $828 million profit they had last year in the same quarter. And for the first 9 months, operating profit is down to just $644 million from nearly $3 billion last year. This is a huge red flag. Now, a big chunk of this loss is due to something called fulfillment network impairment and related charges, which amounted to a staggering $2.6 billion. Basically, they had to write down the value of some of their automated warehouses because they weren't working out as planned. Imagine building fancy robotic warehouses only to realize they cost too much and don't deliver the goods. That is a hard lesson, and it hit their bottom line hard. Now, companies often like to show you a cleaner picture by excluding certain one-time events. Kroger does this too, calling it adjusted net earnings. For the third quarter, their adjusted net earnings were $697 million. This is still a drop from last year's $719 million. But it is a world away from that $1.3 billion loss we just saw. For the 9-month period, adjusted net earnings are $2.3 billion, which is a decrease from $2.4 billion last year. While the adjusted numbers look better, the significant drop in actual operating profit this quarter is something to pay close attention to. Looking at the balance sheet gives us a snapshot of what Kroger owns and owes. As of the 8th of November 2025, their total assets were $51.4 billion. On the liability side, total liabilities were $44.4 billion. You can see their accounts payable were about $10.5 billion. This is pretty standard for a company of this size. And then there is the share owner's equity, which stands at $7 billion. This is down from about $8.2 billion at the beginning of the year. This decrease likely reflects the large impairment charges and stock repurchases. When a company buys back its own stock, it reduces the number of shares outstanding, but it also reduces the equity on the balance sheet. Now, let's talk about earnings per S-hair, a number everyone looks at. Kroger reported a net loss of $2.02 per S-hair for the third quarter. That is a big drop from the $0.85 profit per S-hair they had last year. For the 9-month period, earnings per S-hair was $0.23. Down significantly from $2.77 last year. However, their adjusted earnings per S-hair were $1.05 for the quarter and $3.58 for the 9 months, which actually represents a 7% increase for the quarter and a 7% increase for the 9 months, compared to the prior year periods. This highlights how those adjusted items can really change the story. When we look at cash flow, it tells us how much actual cash the company is generating or spending. Kroger generated $4.6 billion in cash from operating activities for the first 9 months of 2025. This is up slightly from the prior year. This is a good sign, showing the core business is still bringing in cash despite the operational challenges. However, when we look at investing activities, they spent $3 billion on property and equipment. This is more than last year and shows they are continuing to invest in their infrastructure. On the financing side, they paid out $659 million in dividends to shareholders and spent $941 million on share repurchases. They are clearly returning capital to investors, which is generally a positive signal. Now let's talk about some of the big legal issues. Kroger has been involved in opioid litigation, and they announced a settlement in principle back in September 2023. They agreed to pay up to $1.2 billion to states and subdivisions, and another $36 million to Native American tribes, plus $177 million for fees and costs. This is a huge settlement, and a large chunk of it is reflected in their financial results. This is a significant financial blow, but it also means they've largely put this issue behind them, at least for the majority of claims. Another major development is the termination of their proposed merger with Albertsons. This deal was supposed to be huge, but regulatory hurdles and legal battles killed it. Now, Albertsons is suing Kroger for a $600 million termination fee. Kroger, however, is fighting back, claiming Albertsons breached the agreement. This legal battle is far from over and could have further financial implications. Remember those massive impairment charges we talked about earlier? Well, that was primarily due to a strategic review of their e-commerce operations. Kroger decided to close 3 automated fulfillment facilities and cancel plans for another. These weren't meeting expectations. This shows a company trying to adapt and cut losses when a strategy isn't paying off. It's a painful but sometimes necessary business decision. They recorded a $2.6 billion charge for this, which is a massive hit to their current quarter's results. Kroger also announced a significant share repurchase program. They entered into an accelerated share repurchase agreement to buy back $5 billion worth of their own stock. This means they are returning a lot of money to shareholders by reducing the number of shares out there. This can boost earnings per share. But it also means less cash is available for other investments or to weather economic downturns. Looking at the overall sales picture again, the slight increase in total sales to $33.8 billion for the quarter is mostly driven by their core grocery business growing by about 1.1%. Their fuel sales are down, which is common when fuel prices fluctuate. It is good to see the grocery side holding steady. Their identical sales, excluding fuel, increased by 2.6% for the quarter. This is a key metric because it measures sales growth in stores that have been open for at least a year. It tells us if their existing stores are performing better. This is a positive sign indicating continued customer demand for their core offerings. Commerce sales are growing by double digits, which is impressive, but it comes with its own set of challenges as we saw with those fulfillment center closures. Their gross profit, which is sales minus the cost of goods sold, also saw a modest increase. However, their gross margin rate is being pressured by several factors. They mention increased pharmaceutical sales, which typically have lower margins, higher promotional spending, and the impact of rising inventory costs captured by the LIFO charge. This is a constant balancing act for retailers squeezing margins while trying to offer competitive prices. Operating expenses, or OGGA, as a percentage of sales increased quite a bit this quarter. This is largely due to those one-time charges we discussed, like the e-commerce network impairment and severance costs. They are also investing in their employees and dealing with rising healthcare costs. Interestingly, their net interest expense has gone up significantly. This is because they've taken on more debt over the past year, likely to fund those share buybacks and other investments. More debt means more interest payments, which eats into profits. The tax rate is a bit of a mixed bag this quarter. They saw a tax benefit this quarter, partly due to classifying a subsidiary as held for sale. This is a bit of an accounting maneuver that can temporarily boost results. So, what is my take on Kroger's latest filing? Well, it is a story of two narratives. On one hand, their core grocery business is showing resilience with steady sales and decent identical sales growth. They are also adapting their e-commerce strategy, even if it means taking a big hit now to improve future profitability. On the other hand, the massive losses from impairment charges, coupled with increasing debt and interest expenses, are serious concerns. The opioid settlement and the ongoing legal battle with Albertsons also represent significant financial uncertainties. It is like looking at a company that is trying to modernize and innovate, but it is facing some heavy headwinds from past decisions and ongoing legal entanglements. They are making big bets on e-commerce and returning cash to shareholders, but the short-term financial pain is undeniable. This is a company in transition, and the next few quarters will be crucial to see if their strategies pay off. Alright, that is our breakdown of Kroger's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.